Most people think that you need a Roth IRA to generate tax-free income in retirement, but that couldn't be further from the truth. In fact, you can use other account types to create tax-free income, including a traditional IRA, which is what I'm about to walk through today. I'm about to show you how you can take a traditional IRA and essentially turn it into a Roth IRA without doing Roth conversions or some other strategy. You're essentially just using the tax code to your advantage. Hi, my name is Jacob Duke, and as the owner of a retirement planning firm, I help people just like you on a daily basis, help them build retirement plans, tax-efficient income plans, and overall just create confidence around retirement. So how is this going to work? How are we going to be able to take money from a tax-deferred account completely tax-free? It doesn't make sense because we put the money into the account, traditional 401k or IRA, we put that money in there while we were working in a tax-deferred manner, and it grew tax-deferred, and whenever we take that money out in the future in retirement, we're going to have to pay taxes on that as income, right? That's typically how it works. Well, I'm about to show you right now how this can be different. So if you structure your income a certain way, you can actually pay no income tax on your IRA distribution. So here's how this is going to work. So you can see here on screen that in 2025, the standard deduction for married filing jointly folks is going to be $30,000, and it's going to be $15,000 if you're single. Obviously, if you're above 65, you can have an additional amount there on top of the normal standard deduction. So let's walk through this. Let's see what we can do to create income out of our IRA completely tax-free. So let's assume this. Let's assume that we're going to take $30,000 out of an IRA, and that's going to be our only form of income, at least at this point. So $30,000, again, we're going to be married filing jointly, okay? And we have a standard deduction of $30,000, okay? So zero, that's our new taxable income. That's our new taxable income. So we took $30,000 out of our IRA completely tax-free. So whenever someone says a Roth is the only way to get tax-free income, that's not true. Now, this isn't the most realistic thing most of the time, right? Most people have some sort of other income, whether it be part-time work or they have some sort of rental income, or maybe they have Social Security already. So let's kind of go down that one. Most people have Social Security in some form. So let's walk through that one. Let's just say that they're married filing jointly, and let's just say that they have $50,000, okay, of Social Security. And they also, let's go back and just use that $30,000 amount here. Now, let's use that, and let's say that's from their IRA. So they're going to have a total income of $80,000, okay? So that's not a bad living. Most people can retire on that amount of money every single year. They've got no debt, so no other crazy stuff that's making them need more money every month. This is just to live, enjoy, have a couple of vacations, and do whatever normal life looks like for them. So $80,000. Now let's kind of walk through this and see what their total tax would be on this $80,000. Based on these two different income sources. Now, if you've watched other videos of mine, you've probably seen me do the Social Security calculations in the past. So walk with me here and follow again, but I'm going to go a little bit faster. If you need to go back and watch those to learn more about how Social Security is taxed, then go back and watch those videos. I'll have them linked down in the description below. So let's take this $80,000. Let's figure out how much tax they're going to pay here. So first thing we got to do is find the combined income, which is going to be $25,000, which is half of Social Security, plus the 30, which is going to be $55K. All right, now we have to run that combined income through the married filing jointly combined or provisional income brackets. And so we know that the first $32,000 is none of that is taxable. We know that the range from 32 to 44, half of that is taxable. And then we know that 44,000 plus is going to be 85% of that amount is taxable. So let's run through this. So 55 minus 32, all right, is going to be 3 and 23 minus 12 equals 11. All right, so we know that this 50% of that amount is taxable, which equals $6,000. And then 85% of $11,000 equals $9,350. Okay. So these two added together. So this amount, none of this is taxable, right? So that equals zero. So this equals, what is that? $15,350. That's how much of our Social Security is taxable. So that's the taxable amount. But we know that we're getting $50,000 of total income from Social Security. So you can see that not all of their Social Security is taxable. In fact, well less than 50% of it is. So we take this $15,000 now, we add back their other $30,000, okay? That equals $45,350. So $45,350 is their new AGI, but remember, $80,000 was their total income. So just slightly more than half of their total income is actually going to be, subject to taxation. So we take this amount, but remember, we have that $30,000 standard deduction, okay? Right, so now we have $15,350, right? And if we look at the married filing jointly tax brackets here, we can see that $15,350 falls within that first 10% bracket, married filing jointly. And so all of that would be at 10%, which means their total tax would be $1,535. So $1,535 of total tax on $80,000. And I'll do some quick math here. 1,535 divided by 80,000. That's only just under about a 2% effective tax rate. 2% effective tax rate on that money. So what we've got is we've got that little of tax on $80,000. So that's essentially a way that you can take money out of your IRA and pay minimal tax. Now, what I want to do here is I want to go back and I want to say, instead of $30,000, right? Instead of $30,000 out of the IRA, what if we reduce that? Is there a way to get this taxable income amount right here down to zero? What if it's possible to take money from your IRA at zero taxes paid and then also pay no tax on Social Security, so a completely tax-free income? And it is possible, and here's how. So let's say we go $50,000 again from Social Security, but instead, let's go with $20,000 here from your IRA. So we're reducing that distribution down. So now our total is $70,000 of total income, okay? And this is going to be in 2025. So $70,000 of total income. Now we have to go through the same process. So we say half of Social Security is $25,000 plus the $20,000 from the IRA equals $45,000. All right, now we take that through those same brackets, which again, we're right here. I'm going to do this because I've got it all mentally locked away. I've done this a time or two. So we take the first $32,000, we subtract that out, equals $13,000 left over. We are going to say minus 12. Remember this right here, none of that's taxable. 50% of that $12,000 is taxable, which leaves $1,000 left over, and 85% of that amount is subject to taxation. So $850, and then we have $6,000. Those two together equals $680,850. That's our new amount of Social Security that's taxable. So based on $20,000 instead of $30,000, we can see that $6,850 that is now subject to taxation compared to $15,350 before. So what happened there is that $10,000 reduction out of the IRA actually minimizes or lowers how much other Social Security is taxable by almost $10,000 as well. So not quite, but close to it. So that's our new taxable income of the Social Security amount. So we have to now add back our other income of $20,000 from our IRA. So that's $26,850. And that's our new AGI here. Okay. So the AGI now is this amount. Before it was the $45,000. So $10,000 less of income reduced our total AGI, $45,000 minus 26, almost $20,000. So we reduced our amount that's subject to taxation by $20,000, but we only have $10,000 less. So what is it going to do? Well, if we know that's the AGI, we know the standard deduction for married filing jointly is $30,000. We know that that is going to be $0 of taxable income because they're going to deduct all their income away with the standard deduction. So they're going to get $70,000, $50 from Social Security, and then $20 from an IRA and pay no tax on it. So that's how you could turn an IRA into a Roth IRA without doing conversions and paying taxes or anything else like that. And in fact, you can do that strategy that I'm just describing right here. You can do a Roth conversion up to that standard deduction amount and do this math here behind the scenes and say, I can do a Roth conversion without any tax to be paid as well. Again, you have to have maybe some other income to supplement that. So maybe you have a Roth IRA you can pull from, or even better, I'm not going to get into it right now because I've got videos on this, but maybe you can do some tax gain harvesting because you got some room here and actually take money from a brokerage account and live off of that money while doing your Roth conversions and paying no tax on the conversion. So if you want to learn more about tax gain harvesting or what that even is, I'm going to have this video right here that you can go watch. It'll also be a link down in the description below. Let me know your thoughts. Let me know if this was helpful, and we will see you next time.